Tooze crashed, how a decade of financial crises changed the world. Embark on a revealing journey through the last decade of financial crises and discover their profound impact on the world. In Crashed, How a Decade of Financial Crises Changed the World, Tooze offers a gripping account of the destabilizing events from the U.S. housing bubble burst in 2008 to the escalating political turmoil and its far-reaching consequences. Explore the economic and political landscape of the European and American crises, the rise of populism, and the effects on global stability. Witness the unfolding of Brexit, Trump's ascendancy, and the shifting balance of power. Gain a deeper understanding of the intricate relationship between politics, finance, and society.
The subprime mortgage catastrophe. Beginning in the 1970s, deregulation of U.S. lending markets created risky yet highly profitable opportunities. This escalated from 1996 to 2006 when U.S. house prices almost doubled, and household wealth increased substantially. Consequently, money lenders started offering high-risk borrowers the notorious subprime mortgages, increasing demand for houses. Securitization, the process of bundling and selling shares of these mortgages, was meant to spread investors' risk. However, in 2008, the housing bubble burst, causing massive defaults and plunging property values. Banks heavily invested in these bundles faced the consequences, with Lehman Brothers being the first to collapse. Despite economist Raghuram Rajan's 2005 warning, the financial industry continued taking major risks, leading to the disastrous 2008 financial crises. European banks' role in crisis. European banks played a significant role in the 2008 financial crisis due to their deep involvement in risky American lending practices. As the housing boom in the U.S. escalated, European banks eagerly invested vast amounts of money into U.S. mortgage securities, leading to foreign banks holding a substantial proportion of securitized American mortgages. Unfortunately, this left European banks more vulnerable than their U.S. counterparts when the crash occurred. With alarming leverage ratios, European financial institutions found themselves short on cash to cover their debts, culminating in widespread panic and massive cash withdrawals by investors. The initial distress signals from European banks marked the beginning of a financial catastrophe that spread worldwide. During the U.S. housing boom, European banks enthusiastically invested in the American financial sector's riskiest lending practices. As a result, by 2008, a quarter of all securitized U.S. mortgages were held by foreign banks, primarily European. Moreover, European banks held 29% of high-risk securities, with British bank HSBC investing $70 billion in U.S. mortgages pre-2005 alone. When the inevitable crash occurred, European banks found themselves in an even worse situation than American banks. Leverage ratios, the relationship between borrowed money and a bank's actual holdings, for major European banks like Deutsche Bank, UBS, and Barclays, were at least 40-1, double the 20-1 average for U.S. banks. This staggering difference implied that European banks didn't have adequate cash reserves to address their debts in a crisis. As the situation rapidly deteriorated, European banks scrambled for a solution. Both Swiss and British central banks held less than $50 billion each, while the European Central Bank possessed a mere $200 billion, falling drastically short of the $1.1 to $1.3 trillion required to cover their loan activities. This lack of sustainability became evident a year before the collapse of Lehman Brothers when French bank BNP Paribas froze its funds due to the unstable U.S. property market. This move sparked panic among investors, leading to a frenzied race to withdraw cash from the stricken financial system. Ultimately, European banks' involvement in the U.S. housing market contributed significantly to the disastrous 2008 financial crisis. The 2008 financial fallout. The 2008 housing crash sent shockwaves through global financial markets, leading to the largest drop in trade between wealthy countries since the Great Depression. The U.S. Federal Reserve swiftly intervened, injecting $1.85 trillion into the banking system through quantitative easing. In contrast, Europe's individualistic response to the crisis, driven by Germany's unwillingness to cooperate, exposed the vulnerabilities of the Eurozone, especially in countries like Greece that couldn't print their own currency. The fundamental differences between the US and Eurozone approaches highlight the importance of a coordinated response in dealing with financial crises. The catastrophic events of 2008 brought the global financial system to its knees. Trade between the world's richest nations plummeted from $17 trillion to a mere $1.5 trillion, and 800,000 Americans were losing their jobs each month. The 2008 housing crash had a devastating domino effect, causing an unparalleled financial turmoil. To stem the bleeding, the U.S. Federal Reserve boldly nationalized large portions of the mortgage finance system and embarked on a program of quantitative easing. By printing dollars and buying mortgage-backed securities, the Fed eventually managed to pump $1.85 trillion into the ailing banking system. On the other side of the Atlantic, the Eurozone countries struggled to adopt a united solution to the crisis. Germany, under Chancellor Angela Merkel's government, defiantly opposed any joint efforts. There were deep-seated reasons for this. Germany didn't want to use its taxpayers' money to help indebted countries like Greece and Ireland, and the experience of German reunification in the 1990s had left a lingering aversion towards burden sharing. This uncompromising attitude exacerbated the Eurozone crisis because countries that adopted the euro, such as Greece, didn't have the ability to simply print more currency to resolve their debt issues. Without a coordinated strategy, Eurozone nations were left to fend for themselves. In sum, the 2008 financial crisis exposed the vulnerabilities of the world's economic systems. The U.S. Federal Reserve's rapid response contrasts starkly with the Eurozone's individualistic approach, demonstrating the importance of collective action in the face of financial catastrophes. Cooperation, rather than individualism, must be at the heart of future efforts to resolve global crises. Averting Eurozone collapse. European leaders like Merkel hesitated to extend debt relief to smaller Eurozone members, which left countries like Greece and Ireland struggling with insurmountable debt. The International Monetary Fund, IMF, intervened, bringing relief at the cost of strict austerity measures, causing lasting political consequences. When countries such as Greece and Ireland found themselves burdened with massive debt, major European leaders were reluctant to provide debt relief, not wanting to risk their political capital. Let's consider Ireland, a small nation with a population half the size of New York City. Its banks had acquired debts worth over 700 times the country's GDP. When a bank run seemed impending, the government assured creditors they would back the debt of Ireland's 6 largest banks, a promise which ultimately led to the state's bankruptcy. Greece faced an even bleaker scenario. Before an economic crash, its deficit amounted to 10% of its GDP. In 2010, Greece was expected to repay €53 billion to its creditors, leading to the country's insolvency. This endangered the entire Eurozone. As smaller countries faced collapse, larger members like Germany and France risked destitution. Germany proved especially resistant to a joint recovery program. Urgent action was required to save Greece and other debt-ridden countries like Portugal, Ireland, Cyprus, and Spain. The International Monetary Fund, IMF, stepped in to resolve the stalemate. German Chancellor Merkel and then US President Barack Obama supported the IMF's involvement. For Merkel, this appealed to her voters more than an intervention by the European Central Bank, ECB. Obama, on the other hand, feared the Eurozone crisis would jeopardize America's recovering economy. Inviting assistance from the IMF was a humiliation for many Europeans, as this organization typically dictated policy to poorer, developing countries rather than wealthy Western democracies. Nevertheless, in spring 2010, Troika, consisting of the IMF, ECB, and European Commission began imposing policies on Greece and other struggling Eurozone countries. Their proposition was straightforward: bailout payments in exchange for implementing stringent austerity measures. Greece experienced the most severe changes, including a raised retirement age and VAT, reduced public sector jobs, and decreased pay. While this plan successfully averted an economic contagion, the political repercussions of these harsh austerity measures continued to echo in the years that followed. Eastern turmoil, Ukraine's dilemma. The economic recession didn't spare the former Eastern Bloc, leading to the re-emergence of old tensions, particularly in Ukraine. As the economies of several ex-Eastern Bloc countries became heavily reliant on foreign investment, they found themselves caught in the historical rivalry between Russia and the West. Ukraine, witnessing the success of Poland after aligning with the West, aspired for quick NATO membership. However, they faced an economic crisis as their steel industry collapsed. With inadequate offers from the IMF and EU, Ukraine accepted Russia's generous proposal, sparking protests and violence. In the end, Ukraine's president fled, a pro-West government took over, and Russia retaliated by annexing Crimea and fueling conflict in the region. The economic turmoil of the late 2000s reached beyond the Eurozone to the former Eastern Bloc, giving rise to a fierce battle for influence between Russia and the West. Countries like Poland, Latvia, and Estonia became increasingly dependent on foreign investment to sustain their economies. With Russia and the West vying for influence, these nations faced the difficult decision of choosing their allies, NATO in the West or the Russian-led Eurasian Customs Union. Ukraine opted to follow Poland's prosperous path and applied for fast-track NATO membership in February 2008. While Germany's Angela Merkel welcomed this move at a NATO summit, Russian President Vladimir Putin saw it as a provocation. Soon, Ukraine experienced its own economic crisis with the collapse of the steel industry, which both the West and Russia seized upon to secure their interests. The IMF and the EU offered Ukraine a disappointing $5.6 billion in assistance, while Russia presented a $15 billion loan and an attractive gas contract in exchange for joining the Eurasian Customs Union. When Ukrainian President Viktor Yanukovych accepted Russia's offer, massive pro-European protests erupted in Kiev, leading to violent crackdowns and Yanukovych's eventual escape from the country. An interim government seized power and signed the IMF-EU deal. Enraged, Russia refused to acknowledge the new government and retaliated by annexing Crimea and supporting separatists in eastern Ukraine, leading to a devastating conflict that cost over 10,000 lives. London's financial hub evolution. The aftermath of the global crash deeply impacted the UK and shifted the hierarchy of financial hubs. Initially, London rose to prominence as a global financial center due to the Bretton Woods Agreement between 1944 and 1971, which established the US dollar as the world's reserve currency. This system facilitated growth, simplified trade rules, and reduced economic volatility. In the post-war era, the American Federal Reserve and Treasury assumed greater control over monetary policy, leading to more stringent regulations on banking. Investment bankers sought a global hub with lighter regulations, and London fit the bill, becoming the center for offshore dollar lending and borrowing. By 2007, London had risen to great heights, with $1 trillion in foreign currency traded daily and 250 foreign banks located in the city. However, the 2008 crash crippled London's financial sector, leading to the nationalisation of two British banking giants, Lloyds HBOS and RBS. European banks in London, such as Deutsche, Barclays, and Credit Suisse, also suffered, placing them at a disadvantage compared to their Wall Street competitors. In 2014, the British think tank Z/Yen ranked Wall Street above London City in their annual report for the first time. The future for London remains uncertain, as the author suggests that the mishandling of the financial crisis and the continuous Brexit negotiations will result in American-Asian trade bypassing Europe entirely. The path to Brexit. The decision for the UK to leave the EU stems from a long-standing tradition of Euroscepticism, especially within the Conservative Party. The country's worries about maintaining London's status as a global financial hub and the recession following the 2008 crash further fueled these concerns. As austerity measures took their toll on public services, many sought scapegoats and found them in Eastern European migrants and out-of-touch elites. In 2011, polls showed less than 50% of Britons wanted to stay in the EU, leading to demands for a referendum. Prime Minister David Cameron agreed to hold a vote to appease MPs, expecting a win for the Remain camp. However, unresolved Eurozone issues and minimal concessions from the EU contributed to a decisive majority voting to leave in 2016. As Brexit negotiations loomed over the UK, many people wondered how and why the decision to leave the European Union came to be. Part of the answer lies in a history of Euroscepticism in the UK, particularly among the Conservatives. Moreover, there were concerns that EU membership might threaten London's place as a leading financial centre. The 2008 financial crisis and the subsequent recession intensified these apprehensions. The Conservative-led coalition's austerity measures negatively impacted public services, like the National Health Service, leading to a search for someone to blame. Eastern European migrants and distant elites became the prime targets for public anger. By 2011, less than half of the British population wished to stay in the EU, and 80 Eurosceptic MPs began to push for a referendum on the UK's EU membership. In response, the coalition government announced in 2013 that a referendum would take place within 4 years. Prime Minister David Cameron, though not against staying in the EU, saw the referendum as an opportunity to appease his MPs and hoped the Remain campaign would triumph. His calculations were soon challenged by the enduring Eurozone crisis and lack of substantial concessions from the EU. In the 2014 European elections, Eurosceptic parties like the United Kingdom Independence Party, UKIP, and the French National Front made significant gains, further complicating Cameron's position. When the 2016 referendum finally arrived, Cameron had secured only minimal EU concessions, and the contested campaign ultimately led to the UK voting to leave the European Union. Wall Street's unfair rewards. The 2008 financial crisis highlighted the chasm of wealth inequality and unfair advantages given to those Wall Street executives who played a role in the crash. As millions of Americans lost their homes, struggling financially, an outrage grew around the financial elite receiving bailouts and sizable bonuses. For some, it felt like a rigged system. This discontent fed into political movements on both the left and the right, highlighting that it's not just about the size of government but also about who the government serves. The aftermath of the 2008 financial crash revealed a disturbing truth to the American public: those who were responsible for the crisis seemingly walked away not only unscathed but also rewarded. Wall Street doled out $18.4 billion in bonuses in 2008, with some of the most notorious executives cashing in. AIG, an insurer responsible for insuring banks like Morgan Stanley and Goldman Sachs, displayed negligence by not having a fallback plan to protect its investments. Despite AIG experiencing a record-breaking $61.7 billion in losses, it still awarded employees in its financial products division bonuses between $165 and $450 million. Ordinary Americans, in contrast, were grappling with the repercussions of the crash. Millions lost their homes as subprime mortgages became unmanageable. In Florida alone, around 12% of all properties were foreclosed or abandoned in 2010. This widening wealth gap and prioritization of the well-to-do elite gave rise to a pervasive belief that the system was rigged in their favor. The idea of a wealthy elite controlling the nation's wealth resonated across the political spectrum. The right-leaning opinion website Breitbart claimed that working-class Americans were deliberately set up for a fall. The left-leaning Occupy movement pushed back against the meager few hoarding the nation's riches. As the saying went, the system isn't broken, it's rigged. Prominent figures like Robert Reich, former Labor Secretary under Bill Clinton, argued that the issue was not the size of government but rather whose interests it served. Even billionaire Warren Buffett proposed a 35% income tax on top earners. However, this idea was quickly dismissed by Republicans in Congress. As more evidence surfaced of the government disproportionately benefiting a slim portion of the population, the cries for change grew louder. The results of the 2008 crash showcased not just a financial crisis, but a crisis of trust, fairness, and accountability in America. Unmasking 2016's American Discontent. The 2016 U.S. presidential election saw resentment toward the establishment boil over, as frustrated Americans sought candidates matching their anger against traditional political figures. This was absent in the 2012 elections, as neither Obama nor Romney represented a break from established politics. In 2016, both Bernie Sanders and Donald Trump capitalized on this anger, with Sanders calling out Wall Street's profound influence and Trump pointing fingers at China for taking away jobs. Surprisingly, the Democratic Party nominated Hillary Clinton, a Wall Street-friendly candidate, as their representative despite the evident frustrations, leading millions of her potential voters to support Trump instead. Ironically, rather than addressing inequality, Trump's policies have further benefited the wealthy, leaving us to wonder where the simmering rage will find an outlet in the coming years.
As we emerge from a decade of financial crises, Adam Tooze's It Crashed leaves us with an unyielding reality of the interconnectedness between politics, finance, and society. The 2008 financial crash shattered the world economy, leading to a ripple effect across nations, aggravating socio-political tensions and fueling the rise of populism. The historical events Tooze uncovers serve as a potent reminder of how our world has been shaped by financial turmoil and the risks taking root in our interconnected global community. The legacy of the crash echoes through our current political narratives and policy decisions, posing questions about where we go from here and how, as a society, we can navigate and learn from the turbulent past to build a more resilient future.